What's up, everybody? Dan Warby with Keller Williams, West Ventura County here. Hope everyone's doing great. So this week I wanted to touch on the very basics of investing in residential real property for a couple of reasons. First, we've been hearing a lot about inflation recently, and I think it is here to stay. Real estate traditionally has been one of the best hedges against inflation, and with a lot of analysts saying that the stock market is overvalued and overpriced at the moment, it looks like residential real estate is a more and more attractive option. Secondly, we're probably in for several interest rate hikes, probably at least 3 in 2022. And while rates are creeping up already, we're still in a historically low period when it comes to mortgage rates. But what if you've never invested in real property before? It's different than owning a primary residence because a primary residence is not really an investment. You can't treat it as dispassionately as you would a rental because it's very disruptive to move, especially if you have kids in school. So I wanted to go over the very basics of investing in real property real quick as a jumping off point for brand new investors. The first thing to keep in mind is the profit from your investment, or ROI. I know, duh, right? But there's a little bit more to it than meets the eye. There's two things to keep in mind, and that's price and income. So if we purchase a property for, say, $375,000 and it needs, say, $25,000 in repairs and updating, the price we use for our later calculations should be $400,000. We should shoot for a rate of return of about 6%, or in this case, $24,000 or around $2,000 a month. But remember, that property is not going to be rented every single day. So we use a standard occupancy rate of around 85%, making it about $1,700 a month. The second thing to keep in mind is that property condition. We all love watching HGTV and fantasizing about picking out the perfect quartzite countertops, but more often than not, where we need to spend the money is in health and safety related repairs, like fixing an outdated electrical panel or making sure the water heater is braced and secured and has a proper thermal expansion tank. After all this is done, then we can think about paint colors and plantation shutters and fun stuff. The third thing to think about is ease of leasing. Some neighborhoods are going to have very high occupancy rates, closer to that 85% we talked about, but some are going to be much, much lower, maybe down to 75% or even 60%. That doesn't mean they're bad investments. The appreciation potential may more than offset that, but you need to know what that number is to be able to factor it into your decision making. Number 4 should be the local area. Every area has pluses and minuses. Take Port Hueneme, for example. It has numerous condos and townhomes that can be had for under $500,000, and with HOAs that can take care of a lot of the maintenance that you'd otherwise have to do yourself with a single family home. But you also have a neighborhood that's in transition and that's largely dependent on the military base. And you have salt air that's going to increase your maintenance costs significantly. Well, that should be enough to get the wheels turning. Property investing is a very deep rabbit hole. There's a lot to learn. If you have any questions, please feel free to let me know in the comments. Don't forget to like and subscribe, and have an awesome rest of your week, everybody.